Good morning. It's Monday, October 28th, about 6 a.m. Central Time. All right, the precious metals, they gapped lower, but they limited their losses with the liquidation in crude oil after Friday's steady rise following reports from Central Command indicating that U.S. military had shifted key assets around the Middle East, creating heightened geopolitical risks. After that tweet came out, we saw kind of a chain reaction. This was Friday afternoon with, energy prices rising, foreign currencies declining, the dollar index and gold, they rose together as safe haven assets, and the U.S. equity markets really sold off. This is where kind of following some of the proper Twitter feeds really kind of gives you an edge on some of these breaking key news events. So if you don't follow me, you can follow me on Twitter. It's just at Streible. And what I do is I'll pump out and I'll retweet a lot of key items, key things that are breaking news that I think are going to shift some of the markets. I also post a lot of internal research out on that Twitter feed as well. So it's a good follow for you guys. Now looking at the overnight price action in December gold, down $10.90 right now, 27.43. High of the session was 27.5660. That's where you had a little bit of a gap lower, and then we sold off from there. You've got the silver market down 18 cents, 33.60. High of the overnight session, 33.88. Low, 33.39. So you got about a 40-50 cent range right there. Copper futures, they opened up a little bit firmer and then they pulled back. There was news reports out of China with their construction industry slowing down a bit and that copper consumption kind of coming off with it. So no real big action in the copper market. It is a little elevated from the previous week's lows, and we're kind of hanging in here in no man's land. We do have aluminum down 27 bucks, platinum down $5, palladium continuing to rise, up $18 at 12.20. So that's been a good steady bull here at the moment. Its problem is that the contract has a bit too wild of swings, and also the margin requirements are quite high. Bid offers are quite wide as well. That's why we don't have a lot of client exposure in there. However, our metals fund will maintain positions in the palladium market. Now, the big mover and shaker in the overnight session here was the crude oil market. It seemingly gapped lower over $3, sold off from there, recovered just a bit on some bargain hunters stepping in the market, and then kind of rolled over. So we're down 6% right now, down $4.30 at 67.48. I'm going to be looking at longer term picture here. I believe that crude oil prices can find some kind of floor in this area and we can start to rise from here. So again, the way I'll approach the market, because of the fact that it is a counter trend trade, I'll start looking at calculated risk call options going out to March. I'll also look at that 100 barrel contract. So every $1 move on crude oil is going to impact someone's account $100, and I'll start to look to layer into those on a steady decline here and kind of dollar cost average. Now this week we are going to have a lot of economic data to watch. We also have the U.S. earnings season. It's going to peak with 30% of the S&P 500 are going to report earnings. So expect to see some volatility in the U.S. equities. We'll also have 5 of the Magnificent 7 companies. So Alphabet, Amazon, Apple, Meta, and Microsoft, they will all report as well. So traders are also going to have a lot of U.S. economic data to digest. So it really kicks off Tuesday. You're going to have the JOLTS, the consumer confidence. Then Wednesday, ADP and GDP. Thursday, you're going to have the Bank of Japan and also jobless claims. And then Friday, you'll have the employment data in ISM. It's also going to be a big data release for the Eurozone. You're going to have third quarter GDP and then the October CPI on Thursday. So expect just a ton of volatility in all these markets here. This is where I suggest using more of those calculated risk trades. And if you could look at through a lens at how a lot of the clients are positioned here, they have mostly pared back a lot of their exposure to many of the futures contracts, kind of paring it down to those minis and micros, and then also have switched to a lot of calculated risk options and call spreads. So looking at the economic data of the ECB, that is going to dictate the size and the potential of their interest rate cut at the December meeting. You look at our November meeting, it's hanging in at about a 97% chance that the Fed will cut 25 basis points. Now, getting back to earnings, something that's really important, because I talk to a lot of people will call in, they'll want to discuss, how we are approaching these markets with our clients, and I'll ask them how they are approaching these markets. And many of you that I speak to only trade mining stocks or they only accumulate physical metals. Now, the way that I approach the precious metals, and I think is the most effective way, and I think that many of our clients have incorporated this into their mix, is that they maintain exposure to all the elements of the precious metals through investing. So they have the physical, they have the miners, they have the futures contracts as well. Because with gold prices at record highs, we saw disappointing results last week by the world's largest gold miner. We saw that, these gold mining companies are really struggling to isolate themselves from rising inflation costs. And what I'm specifically talking about is Newmont Mining. Their shares posted their biggest daily drop since 1997. So on Thursday, we saw a 15% drop. We saw a 3% drop on Friday. And even in some of its top rivals like Barrick Gold Corp, it also declined. So you got gold futures up 30% on the year. Why aren't these miners all participating? Well, it's because of the fact that their fuel costs. So that's one of the most significant exposures and expenses to a miner, and also labor costs. They remain quite elevated for longer, and I expect the labor costs to really weigh in here. So you look at Newmont Mining, they pay about $1,600 an ounce to mine gold. The expectations were for about $1,350. So you got about a 15% increase in your costs. And really those costs were associated with the mines that they operate in Australia, Canada, and Peru. And operating in undeveloped countries, you really pose a lot more risks like nationalization. So again, you got labor strikes, debt to workers, the remoteness of a project, the maintenance that all weigh in on these particular products and weigh in. So the miners, they're going to pitch to you, and the way these things are written up is that, it has better returns than owning the gold and things like that, and it's got greater investment options and payouts to the shareholders. The reality is that if you want exposure to one of these metals, why not just buy the metal itself? And why not utilize the futures contracts where you can control the leverage and things like that? So I'm not bashing miners by any means on this video, nor that I want to present it that way, because if you look at our wealth management clients, they do own about a 2.5% stake in Southern Copper. We also have a 1.5% allocation in Cameco, and we have many other commodity related names. So they do fit a purpose in someone's wealth management portfolio. But what I'm telling you is have a broad range of exposure to different types of investment vehicles when it comes to the precious metals. And I would suggest incorporating, the futures contracts in there as well. So looking at some of these big pictures here and looking at what the markets are doing at the moment, gold futures, they are consolidating at the moment here as they tend to wait and see what this economic data is going to bring. I think traders are scaling back some of their larger bets here, coming into the election, coming into all different sorts of things that could impact things negatively. We saw silver. Remember, silver futures last week, I questioned whether or not it was going to be hit by the sell-off in the U.S. equities, and that's what we saw. So with 30% of the S&P 500 reporting earnings in this barrage of economic data, you could see another breakdown in prices here. Now, again, I don't want to be negative at all. One thing I do on the weekends is I kind of back up and I look at what are the larger price ranges to start looking at. What are my lines in the sand? This is where I really measure and map things out. And if you look at the gold market, I think your real critical level support on today is going to be right around, you've got that 27.30, I think is your first line of support. Below that's going to be 27.14 with a little bit more volatility in the silver market. I think it's right around 33.24, your first level support, 32.59 below that. That's that old resistance, new support. If you look at the line in the sand on the gold market, it's 26.98. That's where if we broke below and we closed below 2,700, I think that we're going to shift back to a neutral trend. I think long term, you've got support at 2,500. That's where I think the new floor on the gold market is. I think that gold futures could rally on up to 3,000. I did read a really interesting report by Deutsche Bank they put out over the weekend. And what they did was they looked at both candidates and what their projected spending, what types of measures they could get done, and what they predicted that gold futures could be at the end of both terms. And it was quite elevated from here. So I really like that report because it was quite data driven as well. You get into the silver market. Silver's really big line in the sand is closer to like 31.82. So we need to see a big breakdown in prices from here. What I don't like is the way this chart pattern is forming out. It really leaves a trap door open for a big sell-off here. So we're going to want to scale things back, have some of these more calculated risk type trades going on. And you can look at things, how things are projected with the implied volatility. You can see that gold's complacency around certain levels like 27.50. You go to the options market, the implied volatility is only about 17%. You go to the silver market, that implied volatility in the options is closer to 35%. Now, one other thing, a lot of the news headlines over the weekend were quite negative towards the precious metals. You saw something like, gold dips on Israel's limited response. You've also got Chinese gold demand had plunged to record lows as jewelers are not buying a lot of gold because of these high prices. And then you also had copper decline as China's construction spending disappoints. Those are news out of the Bloomberg headlines that a lot of people, a lot of wealth managers and things are going to read that have access to the terminal that might pare back some of their positions on that. But you guys got any questions, give me a call, 312-858-7303. Remember, futures option trading does involve risk of loss, may not be suitable to all investors. Good luck, good trading.